Hey there, everyone. Happy Monday, March 31st. Happy end of Q1. Not a bad way to finish things. We'll talk about the market conditions in a moment. But first, welcome to our daily market recap. My name's Dave Keller. I'm the founder of Market Misbehavior, coming to you from a beautifully sunny, kind of overcast Redmond, Washington. Appreciate you joining along as we recap the market action every trading day. It's been such a pleasure to get the show going and to keep you informed during arguably a very tumultuous, noisy period in market history. But we're here to help you navigate the markets together. As a reminder, I can see questions coming in on all of the live stream platforms that we're streaming on: Facebook, LinkedIn, YouTube, and X. So thanks so much to those of you tuning in live. Apologies for the late kickoff. I was actually at the Stock Chart studio, not too far away here in the Redmond area, shooting our top 10 charts to watch for April 2025. I'll let you know as soon as that is posted on the Stock Charts TV channel. It was a lot of fun. I did that with Grayson Rose of Stock Charts back in the studio, comparing notes on the markets and highlighting 10 stocks that we thought presented some decent opportunities here going into to April. Again, that should be posted here very soon, and I'll certainly let you know when that's ready to go. So sorry for a little bit of a late kickoff, but thanks for hanging with me. If you are tuning in live, feel free to drop questions as we go through the live stream. At the end of the episode, I'll try to take a question or two before we wrap for the evening. If you're watching the replay on YouTube, drop a comment in the comments section as well, because we'll do an all mailbag episode at the end of the week, and we'd love to feature one of your questions on the air. Let's talk about the market conditions here to get things started off. We can see, let's see, S&P 500 actually managing to be in the green. And what's interesting is the S&P was pretty weak at the open, right? We started out very much at a position of weakness down to S&P 5500. That is an important level. We'll come back to that on the daily chart of the S&P, because that is arguably one of the most important levels so far in 2024. That's the swing low from January. That was the bounce that we saw, or from February, the bounce higher that we saw, and then the rotation lower, all around that 5,500 level. So we'll see if that level is able to hold. For now, it is. And earlier in the day, as we opened weaker, felt like we might be entering a period of a breakdown. At which point, I think our downside objective around 5,100 probably put into gear. Didn't stay below there, and very quickly saw plenty of buying coming in at 5,500. You can insist that that is a remarkable coincidence that we find support at the previous low and manage to hold it. In my opinion, that is not a coincidence. I think a lot of people looking at that low, maybe expecting support there, and enough buying power off of that level creates that bounce we are all expecting. So by the end of the day, the S&P finishing higher by about 0.6%, closing just below 5612. The NASDAQ composite did finish slightly lower, but by the end of the day, it wasn't too bad, about 0.1% to the downside. So almost regained that initial gap down, regained it back to the Friday close. The Dow actually finished up 1% back above 42,000 after breaking below there on Friday session. Mid caps, small caps, all in the green as well. The VIX actually moved higher, so that's worth noting. A lot of people sort of scratch their heads when you hear stocks higher, VIX higher. But that's sort of what this sort of environment can kind of do. The uncertainty, the VIX, the volatility, the fear is remaining elevated. Even if we ended up finishing positive, it was a weaker open. So the VIX finishing above 22 now for the first time since that bounce coming by earlier this month. All right, we'll get in some of those charts in a little more detail when we get to the chart review portion. But first, let's check in on some of the other asset classes. The yield curve, essentially not too much of a change, and it was sort of mixed results. The shorter end after drifted slightly higher, the longer end drifted slightly lower, but again, not by much. I'm going to call that essentially an unchanged day in terms of the interest rate structure, in terms of the yield curve. Bond prices did move higher. The TLT was up about 1%, so stocks and bonds finished higher today. The dollar index, again, not much of a change from yesterday's close, or Friday's close, that is. Looking at the commodity space, we can see gold continuing to press new all-time highs, finishing the first quarter at another new all-time high, well above $3,000 an ounce for gold, and the GLD up about 1.4% today. Interestingly enough, silver actually was flat today. So gold up pretty big, silver flat, copper prices down. So even within the metal space between precious metals and industrial metals, quite a dispersion there. Crude oil prices pushed higher today, along with the rest of the energy complex. The USO was up about 3.4%. Energy ended up being third or fourth on the list, fourth, it looks like over there. We'll get to that in a minute. Cryptocurrencies basically had a rough weekend. You can see Bitcoin rotated lower, and going into the equity trading session, we're down in that 83,000 range. It's pretty much where we're at as we go live here around 5:20 Eastern. Bitcoin currently just above 82,550, and that's not too much of a change from where we ended the day on Sunday. All right, let's look at the 11 S&P sectors. We can see that by the close, all 11 of them managed to be in the green. So not a bad day sector-wise. We can see staples, one of the arguably most defensive sectors, at the top of the list. And I'm not going to give away the names that we talked about in the top 10 charts to watch for April, but a couple staples, at least two, I want to say, out of the 10 were consumer staple stocks. So the XLP getting it done today, up 1.6%. Financials, number two, up 1.2%. Utilities, number three, pretty much tied with energy and materials and real estate, all up about 1.1% for the day. So that was kind of the average move. Certainly the median return for the sectors. On the downside, technology did manage to finish slightly in the green. We're just basically a rounding error, 10 cents higher from Friday's close for the XLK, continuing to underwhelm on a relative basis. The relative performance of the XLK has been rough and not getting better on a day like today when the markets finish higher, but the XLK barely doing so. Consumer discretionary, the XLY, second from the bottom. And then you have a bit of a gap up to industrials and communication services, both up about 0.7%. I mean, a number of things to sort of think about in this area. I mean, generally offense over defense. My favorite way to think of that is consumer discretionary versus consumer staples. And you can see that ratio is upside down on a day like today. Offense underperforming defense in most of these cases, right? Technology at the bottom, consumer discretionary next to the bottom. Defensive sectors like consumer staples and utilities at the top of the list. So while this was a nice rally during the day, while a weaker open could have certainly gotten dramatically worse, and it went from being Black Monday to kind of a gray, kind of a light, positive Monday, I guess, by the end of the day. So encouraging that you see that buying coming in. How much of that is due to the S&P bouncing off of a very clear support level at 5,500? How much of that is due to the fact that this is the end of the first quarter where there's some window dressing and et cetera? Open question. I think it's something we only answer tomorrow and then Wednesday. And to be honest with you, Wednesday, and I forget what we're calling that day. We'll just call it Wednesday, April 2nd, tariff day. We'll call it. That's, I think, the real question to see what's happened. But again, on a day like today, it's sort of like, the quad witching days. You often have a lot more volume than average. You often have some big moves, and it feels like, okay, that's a big directional bet. A lot of times it's just kind of like a rebalancing kind of shift, and maybe that's some of what we're seeing here as this is the officially the last day of the quarter. Q2 starts tomorrow, and again, I would say even with today's little rally, certainly limping into Q2, I think is the way that I would describe it. Another thing to just observe is the financial sector. We'll talk about the stocks within the XLF, but the financial sector actually remarkably diverse. You have banks, regional banks, insurance companies. You even have a couple different types of insurance companies. Personal P&C, personal casualty insurance, life insurance, etc. You have exchanges, you have data providers, things like FactSet that are more market data companies. There's a whole bunch of different charts in there. And honestly, the banks, things like JP Morgan, Morgan Stanley kind of charts, probably out of all of those buckets, not the best. Maybe regional banks kind of underwhelming as well compared to others. Exchanges, insurance companies, Berkshire Hathaway, which is honestly kind of a weird name to put in financials anyways, because it's sort of an industrial conglomerate with a lot of other holdings. But those are the charts really the most impressive on a relative basis. We'll get to that when we look at the market carpet here in a minute. We updated our Keller market model, the market trend model, as we call it, Friday at the close. No change as of Friday's close. So all four of the major U.S. indexes remaining bearish on the short term and the medium term, remaining bullish on the long term. This one changed today. The small cap market trend model actually turned bearish after today's close. And this widget on stock charts very awesomely during the course of the week, at the end of the trading day, it just does a quick check to see if any of these change, and it reflects those changes. I don't formally change the model until Friday at the close. The idea of this model is you treat Friday close to the next Friday close as noise. You wait until the next weekend to lock in any formal change. So if today was Friday, the small cap model would be bearish on the long term. There's a lot of game left. We'll see what happens over the next 4 sessions, but certainly something to watch, because that is the real bear scenario from here would be the long-term model starts to turn bearish. Last time that happens was in the heat of the 2022 downtrend. Long-term model has been bullish since late 22 for all of those different ETFs. Looking at the breadth conditions here very quickly, you can see it was actually a very mixed day. Look at this. The breadth on the S&P, 79% bullish, 21% bearish. The NASDAQ composite, almost the opposite, 66% bearish, 31% bearish. So bullish. So the S&P 500, kind of a 4-to-1 ratio up to down. The NASDAQ composite, a 2-to-1 ratio down versus up. So the breadth in the growth space, pretty rough today. The breadth in everything else, pretty decent today. Small caps, even though they're continuing to struggle on a relative basis, on a breadth from a breadth perspective, pretty even, not that bad of a day. So this was a very much a weird rotational day when you look at some of the breadth data, sort of an unusual combination of factors sort of turning into today's chart. All right, looking at the Magnificent Seven and friends, these mega cap growth names, you can see Apple actually up almost 2% today. Nice to see Apple at the top of this list. I feel like it's been a while since we've seen that. Alphabet number 2, 0.2% higher. Alphabet's one of those names sort of threatening the 200-day moving average, and we'll see if it's able to hold. Meta, after just breaking down below its 200-day moving average, basically holding flat from Friday's close. On the downside, you see Tesla giving back some recent gains, down 1.7%. Amazon and Nvidia both down over 1% today as well. All right, let us go to the market carpet heat map style visualization. That's what I meant to do right there. I do see some questions coming in, some really interesting ones I'm hoping to get to here, time permitting. So please keep them coming. Anything we don't get to, we'll put in the mailbag for later, but I appreciate you asking some questions along the way. It gives us something interesting to talk about at the end of the episode for sure. Here is what the heat map looks like. I mean, not bad, right? And what's funny is if you bring up the market carpet earlier in the day, 10 a.m. Eastern time, does not look this good, to be clear, right? I mean, it's sort of rough. Now, certain areas of the market were okay from the open, but a lot of things sort of improved. I mean, it went from pretty ugly to much better through the course of the day. Really showed that short-term buying out of the open, really through the end of the day, going into the close. So what happened by the end of the day? Well, I'm struck by how kind of consistently green we see things like consumer staples, like financials, like energy, utilities, real estate, materials. These are all sectors that look pretty homogenous and overall fairly green, with some random exceptions. But overall, those are areas of the market looking quite strong. When I'm finding lots of great ideas in consumer staples, which I feel like I am right about now, and it's from charts that have just been in dramatic uptrends, like Philip Morris and Altria. These are stocks making new all-time highs here again this week. I mean, just these nice, consistent uptrends, sort of beautiful names. You're seeing other charts that that had been chopping around, that are starting to trade up to the upper end of the range, like Tyson Foods, TSN, some of the other food products names, SJM. Smuckers did not make it into my top 10 list, but it was like an honorable mention. If I'd had a 6th pick, I might have put Smuckers as one of those. I opted against it, but it was certainly under consideration. Very close to breaking out, not quite there, but pretty impressive. And then you have some of these names that drew down quite a bit from mid-February to mid-March, particularly the big box retailers like Walmart and Costco. Walmart was up 3% today, so outperformed. Again, still more to prove until I think it looks like a good recovery chart, but again, some really interesting technical setups in the consumer staples sector. And that's encouraging when you're looking for ideas, but also a bit not encouraging when you think that that's consumer staples, which is kind of a boring defensive sector, generally speaking, areas of the market that don't tend to do really well unless the markets overall are struggling. Now, tobacco names actually have been a bit of an outlier. They've done quite well through a series of bull bear cycles, but certainly something to watch. Within the financial sector, I mean, a pretty broad green day across the board. And some of these names, kind of similar to Walmart and Costco, these are names that were doing really well into mid-February, like Capital One, COF, pulled back quite a bit into mid-March, starting to bounce higher. And certainly an area of the market to watch. I'm looking at Visa up over 2% today, bouncing off of that mid-March low, finishing the quarter kind of strong, pushing up towards 350 again. So again, some interesting charts in there, and again on a relative basis, the XLF looks arguably quite strong. Another couple observations: look at the difference between the top names, like in consumer discretionary, Amazon and Tesla, pretty rough. Those are the top two weights in the XLY, and then you have a gap down to like Home Depot. But if you skip those top two names, the rest of the sector not bad, right? I mean, you see like the gambling names, MGM and Caesars, continuing to look like pretty bad charts. That's a great reminder of, price usually goes down for a reason. Anytime I see people buying things just because they're down a lot, charts like this come to mind where downtrends can just persist because again, there's a reason why prices tend to deteriorate. But besides Amazon and Tesla, the rest of the sector, some interesting charts like TJX, like Home Depot and Lowe's, starting to bounce up a little bit. Same with communication services, Alphabet, Meta, Netflix, your top three stocks, basically flat for the day, but down in the cap tier, things like Live Nation, Fox, IPG. These are all charts. IPG may be an outlier because it's pretty weak here going into this week, but something like Fox is almost back to making a new 52-week high. So it's sort of like within some of these sectors, the biggest names, not the most impressive. You have to go down a little bit to find some of the interesting charts. The problem for our benchmarks is Alphabet and Meta have huge weights in the S&P. Something like Fox, not so much. So again, our benchmarks are dominated by some of those larger names, and when they're struggling, there's just limited upside you can really expect. Ooh, I think that's it for the market carpet. I do want to mention, by the way, as we bring up the chart review, we'll continue to look at some of the charts here, but I wanted to let you know I released the latest episode of our Market Misbehavior podcast just yesterday. I interviewed Craig Johnson of Piper Sandler. It was a perfect conversation. We recorded it last Thursday, so just before Friday's sell-off. But I think it's very much worth listening to because he was very keen on that low from March as being a significant low. So I'm sure he's looking at today's bounce and thinking that makes a ton of sense. Worth a listen today to just hear what he was saying. Talked a lot about opportunities, how corrective moves like this, when you go back in market history, whether it's just the fact that prices are down off of all-time highs, sentiment bombed out like the AAII survey so bearish here in recent weeks, the long-term returns from those sorts of conditions are actually quite positive, right? So if you look out 12 months, the market's usually higher in any of those things that I just said. So it's a great reminder to sort of relate the short-term challenge where I know we're all trying to time this corrective move and not get caught on the wrong side of it. But having a proper long-term perspective in these environments is really helpful. So the Craig Johnson interview, we just posted the latest episode of the Market Misbehavior podcast. Also, Jim Paplava, I interviewed him the week prior. A similar sort of theme came out of that great corrective moves like this often present some great long-term investing opportunities. All right, let's look at the charts here, getting to the chart review portion of the day. So here's what things look like. Friday, quite a position of weakness, I would argue, and I don't see anything today that changes this. I see this as a bear flag, which means you have a big downtrend move. You have a bear flag pattern, which is a short-term counter trend move of higher highs and higher lows. We've now broken that bear flag to the downside. I think that suggests much further downside from here. I think that suggests that 5,500 does not hold, and we end up going further. And I'm looking down in the 51 to 5,200 range based on a number of different techniques. And if we do break below 5,500, I'll get those ready and start sharing with you some different perspectives about what we might expect next. But for now, the question is, does 5,500 hold? Again, kind of part not surprised, I guess, a whole lot that given today, the last trading day of the first quarter, kind of quarter end window dressing, the fact that we're testing those March lows, so many, looking at that low as a potential bottom. And so you see a retest, you probably buy and play a potential bounce higher. If and when that doesn't hold, though, that's where things can accelerate to the downside very, very quickly, what we call a waterfall decline. No guarantee that that's what would happen, but in this environment, when you find support, and it's certainly when you have an initial bounce off of there, that's when a breakdown could get very ugly very quick. So being defensive now because there's a potential for that breakdown to happen, I don't have a problem being more defensive now. Even if we rip to the upside, I'm happy missing the beginning of that rip just to avoid participating in a big downtrend. Like that's the game you have to play in this environment. Do you want to have risk on or not? I'm in a risk off environment, I guess would be the way I'm thinking of it. If 5,500 holds, if we continue to hold that support, all of a sudden people would start warming up to the idea maybe this is the low, and that's when you can start to see buying reemerge. For now, I think it's a counter trend bounce. I wouldn't be surprised if we have some choppiness, obviously, going through this week until we get more clarity on tariffs and what actually is going to happen. It's all been speculation and what we're pricing in so far. And I would argue we're not pricing in the impact of those tariffs just yet in terms of what the potential influence could be. And then jobs data on Friday, which is another key data point that the Fed certainly pays attention to. For now, 5,500, that's the line in the sand. That's what we're watching as of today, holding very nicely. Elsewhere, small caps, boy, continuing to just not be the place to be. The small cap relative performance is why I brought up this chart here. I've been thinking a lot about relative performance trends. The relative strength line you see at the bottom is a simple ratio of the IWM, the Russell 2000 ETF, versus the SPY, the S&P 500. When that's going up, that means small caps are outperforming. When that line's going down, small caps are underperforming. And you can see the general trend for multiple years, even during a raging bull market of 2024. Small caps really did not ever take on a significant or certainly prolonged leadership role. Seemed like it was always lagging behind mega cap growth and other things. Now going into 2025, it's sort of okay, what emerges if the Magnificent Seven stocks are no longer leading, which they're not, what takes the place? Is it value-oriented large cap stocks? Is it defensive areas of the market? Is it small caps, maybe a different piece of the market? Tell you what it's not is small caps, and I can see that from the fact that since Thanksgiving of last year, the relative strength has been consistently weaker on small caps. Pretty much anyone I bring on my podcast, at some point I work into the conversation, what about small caps? Are we going to see it? And what's so funny, having asked that question of a number of strategists here over the last couple of months, every one of them says, boy, it should be at some point. Here's what we look for. But then it's never materialized, right? Those things that we talk about as in, well, if these things would happen, small caps would be a great place to be. It just never materializes. And for now, the IWM is below both moving averages. The momentum is negative with the RSI consistently below 50 in the last 6 weeks. The relative performance continually going down. That's not a place I want to be. I want to be in things where the relative strength is improving, not discouraging. All right, the NASDAQ bullish percent index rotating lower in an aggressive way. This actually popped higher very quickly on that counter trend bounce. We made that earlier March low around S&P 5,500. A lot of things bounced higher. A lot of the Mag 7 names, Tesla, Alphabet, others kind of bounced off of that low, and it sort of looked like maybe this is the beginning of a big recovery. The bullish percent index on the NASDAQ 100 got above 60% about a week ago. From there, we're actually back down to around 32%. So only 32 of the 100 members of the NASDAQ 100 remain above or remain in a bullish point figure chart, which means, about 30% of those growth stocks gave a sell signal last week on their point and figure chart. That's a lot. So again, I think this is very much in a position of weakness. I often look for this indicator getting below 30% as a potential bottoming point, and particularly when it comes out above that 30% level, that's your buy point. Kind of hit pretty well here the second week in March, indicating this potential for a nice counter trend bounce. But now that we're rotating lower again, this is once again getting back down into that negative territory. I don't think that would mean a great buy signal. That might just mean we're going down quite a lot here. The VIX, by the way, very noisy. The volatility of volatility was high. The VIX of the VIX pretty high today, and certainly Friday as well. We chopped around quite a bit. The VIX actually at the equity market opened up around 24, almost got up to 25. By the close, it was down toward 22 again. We're still sort of above that basic threshold of 20, above 28. Again, that's a simplification of just what is the VIX generally telling us about volatility. What you also have to remember, and I was chatting with a friend of the show, Dave Landry, who I've interviewed a number of times. At some point, would love to get him on my podcast and just talk about trading in this sort of market environment. But, chatting with Dave about the VIX, and he pointed out some work he had done back in the day about VIX levels. And, he was very adamant that the VIX does not have specific levels. That's not the way to think of it. You want to think in ranges. And that's something we've talked about. I've kind of gotten away from that recently, but you really think about VIX regimes, right? There are years where the VIX is kind of low, generally speaking. There are times when the VIX is kind of high, and thinking about where we're at within that sort of a range, right? Within that regime is what's most important. So what we're seeing now over the last 6 months is a VIX kind of in the upper 20s is often where we find a pretty decent tradable low, and the VIX down in the mid-teens. Maybe that's the new overbought level, right? And sort of the whole level has kind of drifted up a little bit. Something to think about. But again, my very simplistic brain just says, look, over 20 is usually not good. And that's where we remain as of today's close. High yield spreads. This is not updated for today's close just yet. This is only updated through Friday's close. But I just wanted to point out that credit spreads are widening. They're still not wide relative to historical levels, right? If you look at the last 2 years, which is what we're looking at here, the credit spreads, high yield spreads, around 3.5%, well below 5% that we were at 2 years ago. Granted, but we're up a lot from 2.6% to almost 3.6%. That's 100 basis points in a very short period of time. And so spreads are widening, which means bond investors are perceiving more of a risk-off environment. And so they're expecting better compensation for owning bonds of risky companies. This lines up with the volatility increasing, which tends to coincide with the markets going lower. So widening credit spreads are something we've not really seen until the last month. And I would say at this point, that's where the trend is heading. Spreads widening, that's usually meaning bad thing for stocks because bonds are perceived as having additional risk. Offense over defense, and I saw this in the chat earlier, and I would wholeheartedly agree. This is one of my favorite ratios to just think about. Offense over defense, things you want versus things you need. Which area of the consumer space is doing better? It has very much been favoring consumer staples. The equal weighted version of this ratio is in the bottom panel. That's the most important one that I follow. It's continuing to trend lower. Even today, we had this nice bounce higher, and it felt like, ooh, is this a nice bounce off of support? I mean, kind of, right? The S&P did, in fact, do that. But if you look at what led, it wasn't like a bunch of risk-on kind of trades. Things like technology and consumer discretionary lagged, and consumer staples was one of the better places to be. So very much the trend from the peak in February has been risk-off, defense over offense, and that continues through today. All right, a couple individual charts to watch. On Friday's episode, I shared a chart with a couple different stocks that we were looking at. It might have been Thursday's episode now that I'm thinking about it. But Meta is one of those magnificent 7 names actively testing its 200-day moving average. Most of the Mag 7 names have broken their 200-day, maybe trying to test it from below, but really generally have already been broken. Meta and Netflix were the two outliers that had not yet broken their 200-day. Meta finished the day on Friday literally right at the 200-day moving average. Today, we opened below the 200-day for the first time in, I don't know, far off the left side of the chart, over a year away. That was earlier in 2024, I want to say, when that was happening, maybe late 2023, to be honest with you. Today, we actually closed almost exactly, I'm talking to the penny, at the 200-day moving average. So by my read, still holding. Meta pulling out a win, snatching a win from the jaws of defeat today, but something certainly to monitor through the course of this week. I think, maybe whether Meta holds its 200-day going into next this Friday's close maybe that's the question, right? Maybe that's the barometer we really need to follow, because stocks like this unable to hold their 200-day, that's a bad vibe for the markets. Three other charts that are just kind of compelling charts, right? Kind of good charts. And I would tell you that when you're looking for ideas, when I'm thinking of, top 10 charts for April, which we did earlier today. Hopefully that's out very, very soon on Stock Charts TV. When I'm just trying to find some ideas to share there, one of the things I look for are things just in nice confirmed uptrends, because the market itself is not in one of those, right? The S&P not going up at the moment, and what time frame and how much we think it's not going up is debatable, but the fact that it's certainly not making new highs is not is open to debate over the last month. Compare that to gold stocks, and we're looking at KGC, Kinross Gold, making new highs above two upward sloping moving averages. This is just a classic bullish trend. We had resistance in October around 10.50, 10 and 10.7. We kind of pulled back to $9. We broke above 10.50, pulled back. Resistance becomes support right at the 50-day. It's just a classic setup before a nice resumption of the uptrend, making a new high. The relative performance, I think, is what's most compelling on a chart like this, right? In a time when the markets are going down, focus your attention on areas of the market where the relative strength line is improving. Things that are doing better than the benchmark, those are areas that are going to help you do better than just holding an S&P fund and watching it lose value. So focus your attention on things like that. Kinross Gold for now, flashing that. Potential bearish momentum divergence, something I'm certainly watching. We'll see what happens, because this is still an active upswing. But other than that, hard to find anything to not like about a chart like that. Fox Corp, right, in the entertainment group within communication services, some of the big communication services names, Meta, Alphabet, struggling certainly with testing the 200-day. Charts like Fox, way far away from their 200-day, but not in a bad way. I mean, I think this is a chart that pulled back quite a bit, undercut its 50-day moving average earlier in March, but then managed to swing back above. A little pullback to the 50-day on Friday today, pushing to a new swing high here, threatening that February peak. Momentum improving with the RSI pushing above 60 today. The relative strength making a new 52-week high, though. That's what I love about that chart. And then finally, consumer staples, right? When people ask me what types of things you want to own in a bear market, generally things that are immune to economic changes are generally places where you want to be. Think about where you do not tend to change your spending behavior, right? When conditions are rough, when you're a little nervous about future cash positions, when inflation is rough and things are getting more expensive, you probably at some point, if you start cutting costs, you start lightening up on travel. You maybe stay at a not as nice hotel. You fly, coach instead of first class or something you might splurge on. You don't buy the new watch or the really awesome car. You buy something a little less. But if you're a smoker, like, it's not like you adjust your smoking habits because of economic conditions. It's kind of a thing you do, and it's really more of a habit that you are spending on. And so it's more of a consistent thing. Same with beverages, same with household products, cleaning products. These are things that you're just kind of make sure you have in the house, and when you run out, you buy more of it. You don't really upgrade or downgrade your spending. That's why stocks like Philip Morris are compelling here, because again, the behavior of these charts is driven by the behavior of consumers that are probably not changing their spending patterns based on economic conditions. Other consumer discretionary types of names, you very much have that effect. These are more relatively immune to economic instability. And so as a result, they tend to be a good defensive place. And a lot of investors know that, particularly institutional money managers. So they gravitate to these names when they're nervous about what's happening with the markets, because it's a great place to ride out a period of economic uncertainty or instability. So PM making a new all-time high today, up over 2%. Momentum strong, relative strength strong. All three of these charts, relative strength making new 52-week highs today. That is not an accident. Those are the types of areas of the market that I'm looking for right about now. All right, let's take a look. Dodo, love your handle. You're watching on YouTube. I have a portfolio that I set up for my granddaughter that includes only dividend aristocrats. Literally every position was up today. The first time I've seen such unequivocal rotation. Love that comment. I appreciate you watching. And yeah, I mean, high dividend pairs. I mean, with some of these like a Philip Morris, dividend yield over 3%, anything like that is above the average return or average dividend for the S&P. And a lot of growth stocks just don't have a dividend or have a minimal dividend. It's just not a big part of the structure. So defensive areas of the market, things like a dividend aristocrat, these are ones that have consistently paid a healthy dividend and been relatively stable. Not a bad way to grow a portfolio. And what it sounds like you're mentioning, and again, I'm not an advisor. My goal is not to give any recommendation for sure. But again, if your runway's long enough, being in stable companies with the ability to grow over time, kind of a tried and true approach to investing, you probably can't see too much. But this chart over my right shoulder is a long-term chart of the markets, right? And just showing how, generally speaking, equities go higher. So when I have a newer investor with my daughter who's in high school now, when I'm talking to her and just starting to set the stage for a life of hopefully investing thoughtfully and diligently and appropriately, I tell her, like, the most important thing to do is start putting away money now, and your runway, right? The time you have until your finish line, which is hopefully a long, long way off. That is the advantage you have over me or anyone who's been around a bit, is because our runway is just shorter. And so getting in and betting on the long-term growth is a consistently positive approach. So I think you're in good shape for doing that. All right, let's take another question. Jeremy, you asked, I think this is during the market trend model. I saw that and I wanted to come back to it. You had mentioned, what are the inputs? I do have a video that I've recorded that just explains the mechanics of it, which I will definitely share in the links in our description here. But if you go to marketmisbehavior.com/charts, this is a series of charts that I have hosted on the Stock Charts platform that they awesomely keep up there. You can all access it using that URL, and I keep these charts updated in my own login, so you can see what kind of things I'm looking at. This very first chart is the market trend model, and it uses this combination of exponential moving averages on the weekly chart and makes some simple comparisons, the difference between these moving averages, to define the trend on the long term, the medium term, and the short term. It's something I refer to every week with my Market Misbehavior Premium members. The medium-term model for me is foundational. It's one of those basic gut check kind of initial assessments. Do I want to be adding risk on or taking risk off? Do I want to be focusing more on capital growth or more on capital preservation? That medium-term model turned bearish for me at the end of February. And for me, that tells me to be thinking more defensively, just try to be raising cash, because at some point there's probably a pretty viable low. But if you don't sell before that low, you don't have that additional money to put back into the market. So raising cash when things start to look uncomfortable is often a really good way to have money ready to redeploy when we get to a new low. I'll grab a link for that video and share it with you on our YouTube channel, so you can check it out there. Folks, I want to thank you guys so much for following my work, for following my show, for hanging with me today. Sorry for the late start. But again, doing the video for Stock Charts, I'll let you guys know. Hopefully, I'm certainly by tomorrow's episode, we'll have it out. So I'll make sure I include a link. But in the meantime, have a wonderful evening. Hang in there the rest of the week. We'll be broadcasting all week, and look forward to seeing you on the next episode. For Market Misbehavior, I'm Dave Keller. Have a good night. And remember, it's always a good time to own good charts. Take care, folks.